Stop scrolling, because Bitcoin didn't crash on Friday the way the timeline is screaming that it did. Bitcoin was pressing up toward 70,000. The market was getting cocky. Leverage was getting heavy. Altcoins were lighting up. And then, in a few brutal hours, the entire board bled red. People called it a top. People called it a trend reversal. People called it the end of the move. Most of them are wrong. What happened on Friday was not a Bitcoin is broken event. It was a Bitcoin is cleaning the room event. And if you misread the difference, you do exactly what the market wants you to do. Panic at the low, sell to the bid, and watch it bounce without you. In the next few minutes, I'm going to break down what actually happened, why it happened, and what the market is quietly telling you underneath the noise. Welcome back. This is a data-first crypto briefing. No hype, no doom, no guesswork, just the tape, the flows, and the incentives. And stay with me because the last section matters the most. I'm going to show you the two levels that decide whether this was a harmless leverage flush or the first crack in the range. Now, let's talk about Friday. Here's the clean version. Bitcoin ran up fast. It got close to that 70,000 ceiling. That's not just a number. That's a psychological wall. That's where late buyers chase. That's where leveraged traders get bold. That's where liquidity piles up like dry leaves. And then the wind changed. Not inside crypto first. Outside. The trigger wasn't a meme. It wasn't a rumor. It wasn't a random whale deciding to ruin your day. The trigger was macro risk. Specifically, the shockwave from Nvidia earnings and the reaction in the Nasdaq. And I know what you're thinking. What does a chip company have to do with Bitcoin? Everything. Because Bitcoin in 2026 does not trade like a weird internet collectible anymore. It trades like a risk asset with a global liquidity heartbeat. When tech stocks wobble, risk appetite wobbles. When risk appetite wobbles, the fastest money on the planet does the same thing every time. It de-risks. It gets flatter. It reduces exposure. And crypto, because it's liquid, volatile, and tradable 24/7, is usually the first door they run through. That's the game, not ideology. Flow. Now let's zoom in on the move itself because this is where people get fooled. On the day, Bitcoin was down around 1.5% when the dust settled in the snapshot most people were sharing. That's it, 1.5%. In traditional markets, that's a shrug. In crypto, with leverage stacked on leverage, 1.5% is enough to rip out the weak screws. And that's exactly what happened. Bitcoin had pushed towards 70,000 on momentum. Momentum traders piled in. Perpetual futures got crowded. Funding turned into attacks. And the moment equities cooled off, that fast money did what fast money always does. It left. Fast. Here's the part nobody wants to say out loud. A lot of the bullish buying near 70,000 wasn't conviction. It was positioning. It was people renting exposure, not owning it. So when the Nasdaq flinched, the renters handed back the keys. And when enough renters exit at the same time, it doesn't look like a gentle pullback. It looks like a cliff. Red candles. Panic posts. Is this the top? Is this 2022 again? And then, quietly, while most retail was staring at the screen and spiraling, the market did something that doesn't match the doom narrative. It stabilized. The sell pressure hit hardest overnight. And by Friday morning, the hourly returns were already turning green. Read that again. The scary part happened when most people weren't watching. And when most people woke up, the buyers were already stepping back in. That's not what a structural breakdown looks like. A real trend reversal doesn't just spike down and then quietly heal. A real breakdown has follow-through. It keeps pushing. It keeps bleeding. It creates lower lows and refuses to bounce. Friday didn't look like that. Friday looked like a purge, a leverage flush, a controlled burn, because the market had too much speculative weight hanging off the side. When macro risk tightened, the market yanked the rope and shook the tree, and the over-leveraged fruit fell first. That's what liquidations look like in real time. Sharp, fast, ugly, and then oddly calm once the forced sellers are gone. Now let's be even more honest. Even after the drama, Bitcoin was still slightly up on the week in the data we're talking about. Not massively, but positive. So while the timeline screamed crash, the weekly chart said range. That's the first signal. Signal 1. The move didn't break the weekly structure. Now we move to signal 2, because this is where you find out whether the market is afraid or just resetting. Altcoins. If Friday was the end of the bull run, you would expect risk to get punished across the board. You would expect the higher beta coins to get wrecked. You would expect a week full of bleeding. But the 7-day picture tells a different story. Cardano was up roughly 7% on the week in the dataset you're looking at. Solana was up around 5.5%. Ethereum was up around 4.8%. BNB was up around 4.3%. And the key detail is not any single number, it's the pattern. Major altcoins outperformed Bitcoin on the week. That matters. Because in crypto, where capital rotates like a hurricane, relative strength is information. When altcoins outperform Bitcoin, it usually means one of two things. Either risk appetite is expanding inside the crypto ecosystem, or there are strong coin-specific catalysts pulling money into those names. And this week looked like a blend of both. In plain English, the market did not behave like it was fleeing crypto. It behaved like it was rotating within crypto. That's a very different message than trend reversal. Now there was one exception, XRP. XRP was the awkward outlier in the week's snapshot, down on the day and basically flat to slightly negative on the week. And that's not proof the market is dying. It's proof that not all coins move for the same reasons. Some coins are macro. Some coins are narrative. Some coins are regulation sensitive. XRP lives in its own weather system more often than people admit. So the takeaway isn't XRP is weak, so everything is weak. The takeaway is the broader market was healthy enough to rotate into multiple majors, even as Bitcoin chopped under resistance. That's not a bear market signature. Now we need to talk about the range, because this is the cage Bitcoin has been living in, and Friday was a bounce inside that cage, not an escape from it. After the February 5th crash, Bitcoin carved out a tight consolidation band. Ceiling, around 70,000. Floor, the mid to high 60,000s in the snapshot you're working from, with the broader danger zone lower if the floor gives. Wednesday tested the ceiling. Friday backed off. That is classic range behavior. The market is not making a decision yet. It's negotiating. And ranges are where people get chopped to pieces, because ranges are engineered to punish both sides. If you buy the top of the box, you feel stupid on the pullback. If you short the bottom of the box, you feel stupid on the bounce. The range exists to transfer money from emotional traders to disciplined traders. Now here's the part that should raise your eyebrows. The selling was not evenly distributed across the entire day. The heaviest hit happened overnight, and then the recovery started. That matters because it tells you who sold. Forced sellers, liquidated positions, risk managers hitting buttons when volatility spikes. That's different from long-term holders exiting. Long-term holders don't dump in a thin overnight window. They distribute over time. They sell into strength. They don't create a sudden vacuum. So if you're trying to interpret Friday, you have to ask the right question. Not, did it go down? Everything goes down sometimes. The real question is, who was selling? And the shape of the move suggests leverage and fast money, not patient distribution. So the clean summary is this. Friday was a macro-triggered risk-off wobble that flushed leverage from a crowded move near 70,000. It did not, by itself, confirm a trend reversal. But, and this is the cliffhanger, ranges are fragile. The next move depends on what happens at the edges. And that's where we go now. Because the market is not going to tell you the answer with a tweet. It's going to tell you the answer with levels. Level 1, 70,000. If Bitcoin breaks above 70,000 and holds it, not just wicks it, then Friday starts to look like a textbook reset before continuation. Because a leverage flush that clears the runway is often the exact thing the market needs before it can lift again. But that hold part matters. A real breakout is not a 1-hour candle. A real breakout is sustained demand that doesn't vanish when the first sellers appear. So ask yourself, if we push 70,000 again, do we see buyers keep stepping in? Or do we see the same fast money faded and shove it down again? Level 2, the lower boundary. The mid to high 60,000 region was holding in the snapshot. If that zone gives cleanly, and price starts printing lower lows and refusing to reclaim it, then you have to respect the possibility that the range breaks down. Because ranges don't last forever. They resolve. And the direction of resolution is where the real trend begins. Now, let's unpack what a leverage flush actually is, because this is where people get tricked. Crypto doesn't move on spot alone. It moves on derivatives, perpetual futures, margin, borrowed exposure. And borrowed exposure has one fatal weakness. It gets forced out at the worst possible moment. The chain reaction is simple. Price rips into a major level like 70,000. Leverage piles in. Funding creeps up. Then an external shock hits risk, like a NASDAQ pullback after a major earnings catalyst. Price dips. And that dip is enough to trigger liquidations. The most over-leveraged longs get margin called first. Their positions are force closed as market sells. Those sells push price lower, which triggers the next layer of liquidations, and the next, until the weak side is cleared. That's why it looks like everyone suddenly flipped bearish. Most of the selling isn't a change of belief, it's a mechanical unwind. Here's the twist. Once the forced sellers are finished, the market often steadies fast, because the pressure wasn't natural distribution, it was obligation. So when you see a sudden dump, don't ask, is Bitcoin dead? Ask, did leverage just get rinsed? Because that tells you whether the move is likely to fade or follow through. And now the real cliffhanger. A range only breaks when consistent new demand shows up. Fresh capital, new buyers, not just the same money rotating. If that demand arrives on the next push, 70,000 breaks and Friday becomes fuel. If it doesn't, the market stays trapped, until the next macro wobble forces another flush. Now we need to talk about the bigger backdrop most people are ignoring while they obsess over a single red candle. Global flows. Asia. Because the world is not just the US chart, and crypto doesn't live in one country anymore. Asian equity markets were ripping in this period, especially South Korean tech. The region was on pace for one of its strongest February performances in decades, with major South Korean technology names surging on AI infrastructure demand. And the broader Asia-Pacific index was outperforming the S&P 500 across multiple months. Why do you care? Because money is global. Because institutional allocation is not patriotic. Because when capital rotates, it changes liquidity conditions everywhere. And if global risk appetite is being supported by a powerful AI-driven tech bid outside the US, that can soften the impact of a US-centric wobble like a NASDAQ pullback. It can also reshape correlations. Right now, Bitcoin has been trading like a shadow of the NASDAQ, especially on fast risk-off moves. But correlations are not laws of physics. They are habits, and habits change when flows change. If the US tech index goes through a cooling phase while parts of Asia keep running, you can see a world where Bitcoin's relationship with the NASDAQ loosens. Not instantly, not magically, but gradually, as the marginal buyer changes. That would be a meaningful shift. And it's one of the reasons you can't read Friday in isolation. You have to read it inside the bigger liquidity map. Now here's the part where people want a prediction. Is Bitcoin going up or down? If you want certainty, crypto is the wrong place. This market is a live arena of incentives, leverage, and psychology. The right move is not pretending you know the future. The right move is knowing what to watch so you don't get manipulated by noise. So here are the 5 things that matter from here, and I want you to listen like your portfolio depends on it, because it does. 1. The 70,000 ceiling. A clean break and hold changes the conversation. It forces shorts to cover, and it forces sidelined money to chase. 2. The range floor. If the market loses the lower boundary and fails to reclaim it, the flush story turns into a trend shift story. 3. Altcoin relative strength. If altcoins keep outperforming Bitcoin on the week, that's a risk-on tell inside crypto. If they start bleeding hard while Bitcoin holds, that's a risk-off tell inside crypto. 4. The correlation with the NASDAQ. On the next big equity wobble, watch Bitcoin. Does it dump in sympathy immediately? Or does it hold up better than it did before? Decoupling doesn't happen with a press release. It happens when the asset stops reacting the same way to the same stimulus. 5. Leverage rebuilding. After a flush, the market looks calmer. Then people get comfortable. Then leverage creeps back in. Watch funding. Watch open interest. Watch the liquidation heat map. Because if leverage stacks again under a resistance level, the market will do the same thing it did on Friday. It will flush it again. Now let me give you the psychological frame you need, because this is where most people lose. In ranges, the market weaponizes boredom and fear. It bores you until you force a trade. Then it scares you out of that trade. Then it moves without you. Friday was a fear moment. It was designed to make you believe the worst interpretation, because the worst interpretation is what makes you sell, and selling is what gives someone else the inventory they want. So the next time you see a crash headline, zoom out and ask, did we break structure? Did we see follow-through? Did buyers disappear? Or did leverage get rinsed and buyers step in quietly? Those are different movies. So here's how you stay sane in the meantime. You don't marry a single candle. You map the edges. You decide in advance what would change your mind, and you stop letting the timeline decide your emotions for you. If we reclaim and hold above the range midline, you respect the bullish case. If we lose the floor and can't reclaim it, you respect the bearish case. Everything else is just chop trying to steal your attention. Now I want to ask you 2 questions, and I want you to actually answer them in the comments, because your answer tells me what part of the market you're living in. First question, did you buy the dip on Friday? Or did you get shaken out and watch the bounce start without you? Second question, which breaks first, 70,000 to the upside or the range floor to the downside? Drop your take below. I read them, and the discussion helps everyone sharpen their thinking. And now, the short practical takeaway. Friday was not proof the bull run is dead. Friday was proof the market is still crowded, still leveraged, and still sensitive to macro risk. That's not bearish by default. That's normal in this phase. What decides the next chapter is simple. Hold the range and break 70,000 with real demand, and the flush becomes fuel. Lose the range floor and fail to reclaim, and the flush becomes the first step of a deeper unwind. That's it. 2 edges, 2 outcomes, and the tape will tell you which one we're getting. If this breakdown helped you see Friday differently, if it gave you a framework instead of fear, do one thing for me. Subscribe. Because this market moves fast, the noise moves faster, and having a clean, data-first lens is the only edge most people will ever get. We'll keep tracking the levels, we'll keep tracking the flows, and when this range finally resolves, you'll know why it moved before it moved. Don't blink.